Hey, welcome to Nebby Invest. So continuing on my Appendix 4C video series, part 4. And in this video, I'll be looking at Nitro, Candy Club, and Tesserent. Now, for full disclosure purposes, I am a Nitro shareholder, and I have owned Tesserent shares in the past. Candy Club, this is the first time I've looked at Candy Club, so who knows how many more videos I'll do on that company. But they are in a space that is of interest to me, just personal interest. And for some reason, Tesserant just reminds me of the Avengers comic book movie series. And I won't say why, could have a wild guess, and could be quite accurate. So let's get to the first company in this video. And that company is Nitro, the company that I do own at the moment. So they describe themselves as a document productivity software company. And when I think of Nitro, I think of PDF editing, also e-signing, that sort of thing. And one of the main competitors is Adobe. So they do have a market cap, last time I looked, around $600 million. And when you look at their financials for the last financial year, revenue $27.8 million and operating cash flow negative to the tune of 1.6. And looking at those numbers in the market cap, that would suggest that the valuation of Nitro is a little bit stretched at the current time. And I would probably argue that's true for a lot of SaaS companies. So Nitro is a SaaS company, and the market is sort of in love with SaaS companies, so they're willing to pay a bit of a premium, and that's definitely true for Nitro. Now, on December 31st, their annual recurring revenue is $27.7 million. And I highly recommend, if you are a shareholder of Nitro or are interested in potentially buying Nitro in the future, that you do have a look at their Appendix 4C report that they released on 27th of January. And that probably holds true for every single company that has released an Appendix 4C. Go through it. You don't have to go through every single one, but just go through the companies you might be interested in. So when a company releases their Appendix 4C, typically, or a lot of times, not always, there's this whole section where they talk about the activities they went through in the last quarter. So I typically go straight to the Appendix 4C, the real bit where you've got the consolidated statement of cash flows. And the first thing I always go to is Section 1, which is the cash flows from operating activities. I'm always interested in receipts from customers, and of course, whether the company is cash flow positive or negative in operations. In the Nitro case, they do have receipts from customers to the tune of $12 million US dollars, so they do report in US currency, and they are cash flow negative for the quarter of $776,000. So almost cash flow positive, but not quite there yet. So it could be a case of a company that could be cash flow positive if they wanted to, but they decide no, they'd rather spend the money they have coming in the business, they'd rather spend that on marketing, advertising, on some other costs to grow the business for the future. So they began the quarter with $44.4 million in cash and finished it with 43.7. So there's no concerns about future cash for operations. So unless they do a major acquisition, there's no reason why this company needs to do a capital raising. That's always a good thing moving forward. So always likes to go through the receipts history, look at any sort of trend. Now, Nitro listed on the ASX towards the end of 2019, so I only have 5 quarters of history here. And really, if you go back to from the first quarter in October 2019 to this quarter, we only see growth rate for the compound quarterly growth rate of 1.3%. If we take away that first quarter, which seems to be an unusually high number, we do see growth rates of 9.7% since then, which is analysed at 40%. So not high growth for a company with stretched valuation. So I'd like to see these cash receipts grow a little bit stronger moving forward. I always like to look at the chart no matter what, and we do see a good chart here. A really good uptrend from the start of July where the share price was $1.50. It got to a peak of $3.50 and then it's been going sideways since then. So nothing really to complain when you look at the 8-month daily chart. So as a shareholder, over this whole period, I'm not concerned at all and not willing to buy, not willing to sell, just a happy owner, happy holder at this current point in time. So the next company I'll be looking at is Candy Club. This is a confectionery company that operates a business-to-business and business-to-consumer segment in the United States. So this is not an Australian company. They operate in a different country. So always interesting to me when an overseas company decides to list on the Australian exchange. Anyway, so market cap of 48 million. And when you look at some of their financials, particularly the operating cash flow, which is negative 7.3 million, they really have to improve that number moving forward. Now, if you are interested in this company, I do recommend, of course, going to the Appendix 4C, which they released on 27th of January. This is also a company that has fairly lofty ambitions, and it's not always a bad thing to have lofty ambitions, particularly if those ambitions are reachable. I think it can be harmful if those ambitions are way beyond your potential. Anyway, let's get to the operating cash flow. So this is their cash flows from operating activities, section 1 from the Appendix 4C. Receipts from customers, 2.8 million. And the thing I really want to look for here is how that compares to the product manufacturing and operating costs. You can see the 12 months to date, the product manufacturing and operating costs were actually larger than receipts from customers. But this is the first quarter where we started to see the receipts from customers being larger than the product manufacturing and operating costs. That's a thing that shows me they're heading in the right direction. But they are still negative in operating activities, so negative cash, so cash flow negative, you can say, to the tune of 1.2 million. So that's something they do have to address moving forward. You can see at 12 months to date, operating cash flow negative to the tune of 5.2 million, and that means they did have to raise capital. So they began the quarter with only $969,000 in cash and finished it with 2 million. And the reason why that went up, even though they were cash flow negative, was because they did a capital raising of $2.5 million. So moving forward, they might still have to do some capital raisings, particularly because they are cash flow negative, and that's something you have to keep in mind if you are a shareholder or are thinking of buying into Candy Club. And this is just what they're doing, business to business compared to business to consumer. And the one thing I took away from this is they seem to be concentrating on the business to business side of the company. And you can see business to business revenue has gone from 0.46 million in the fourth quarter of financial year 2019 to 2.8 million in this financial quarter. So it's growing quite quickly over the last year or so. But the business to consumer has gone from 620,000 to 490. So they're really focusing on that business to business. Gross margins sort of steady around 41 to 43%. I'd like to see that growing a little bit. And so that's the main things I've taken away from that they are concentrating on business to business and the gross margins are steady for now. So this is their receipts history going back to 2019. So I followed this company for the last about a year or so, and compound quarterly growth rate since the time they've listed is about 5.7 per quarter. But they have started to grow at a little bit of a quicker rate over the last 5 quarters, particularly this quarter. They've grown quite substantially, and the growth rates have increased to 18.4% over the last 5. So I think the most interesting thing with this company is to see if they can continue this growth rate, particularly what we've seen over the last quarter. They've gone from $1.9 million receipts to 2.8. So this is the 1-year daily chart. So not a lot of interest in this company, but we have seen the share price go from around about 4 cents to 16.5 cents. So it has quadrupled in price since the COVID-19 financial panic. And I'll just keep a close eye on this for now. And the main thing I'm looking for is some sort of inflection point, particularly when they become cash flow positive in operations. That would be the time where I become more interested in this company. But the whole reason I'm doing these videos is to give you some ideas. So just because that's the time I might become interested in this company, you might find this company interesting now and decide to buy in. Particularly if they have some perks. So if you are a shareholder and able to get some of the candy for free, that could be a perk that could drive you to buy some shares in them. So the final company I'll be looking at is Tesserent. This is a company I have owned in the past, and it's a cybersecurity company. And they seem to be an aggregator of business, so they continually acquire new business. I think they've acquired something like 8 businesses in the past year. Last time I looked, they have a market cap of 335 million, and the revenue and operating cash flow for the previous financial year, I think you just got to push that aside because those numbers for the next half year, which should be released in the next 2 or 3 weeks, are going to be considerably higher than that, particularly the revenue. So have a look at their Appendix 4C that they released on 29th of January. You'll get a good idea what this company does and where they're headed. Now, when I look at the operating cash flow for this company, you'll see receipts from customers in this quarter alone was almost as much as revenue for the previous financial year. $20.6 million in receipts, but not yet cash flow positive. So negative cash flow for the quarter of 1.3. But I think there's a good possibility they're going to be cash flow positive for future quarters. So they began the quarter with $13.8 million of cash on hand and finished it with 7.9. So considerably amount of cash went out of the business. And the reason behind that was because of acquisitions, $6.1 million in acquisitions. But they also gained $3.5 million with option and warrant exercises. So a lot of cash going out of the business, a lot of cash coming in. So this is the receipts history, and this just shows you how they've been acquiring business and how that's affected their cash flow. So if this was organic growth, I'd be loving the look of this chart. But you can see the compound quarterly growth rate since April 2016 is 15.7%. But you can see most of the growth has happened in the last about 5 or 6 quarters, because between April 2016 and around, we'll say October 2019, there wasn't much growth in this business at all. So the compound quarterly growth rate in the last 6 quarters has been 58.5%, and that's quite phenomenal for quarterly growth. So this is the 9-month daily chart. And the reason I showed 9 months is because you can see there was a lot of excitement about this business back in June, July into August. Share price went from just above 5 cents, and the height of the share price reached about 40 cents or just above 40 cents towards the end of 2020 and into January. So share price has been going sideways for the last 3 or 4 months. And I think a lot of the sort of, I'd say the hype around this company has petered away, but I think the valuations has returned to more normal levels. Wouldn't be surprised to see the valuation of this company go backwards a bit, because there is a bit of wariness about businesses or companies that do a lot of acquiring, and that's how they get the growth through acquisitions, because history shows when companies grow through acquisitions, eventually bad things can happen. Doesn't mean bad things will happen to Tesserent, but bad things can happen, because when you do that, that's your model for growth. You need to pay more and more for those acquisitions eventually. Just look at G8 Education for an example of that. Anyway, I'd like to see how their organic growth is happening, which I didn't quite get in any of the reports. So that's the one thing that's a negative. I'd like to see more organic growth, or see how their organic growth is doing. So that's all I've got for this video series of the Appendix 4C, number 4, looking at Nitro, Candy Club, and Tesserent. Hope you've enjoyed this video. And again, I'm not a financial advisor, so if you do need some financial advice for your own circumstances, make sure you seek out someone who is qualified. So that's all for today. Have a good day. Bye.